This week really has been the best of times, and the worst, for Shanghai stocks acting more like electrocardiogram readings than the perceived value of China Incorporated. Early in the week, plunging shares were making global headlines of the kind policymakers in Beijing abhor. The media buzzed about Chinese equities in panic mode, echoing the epic swings of 2018 or even 2015. By midweek, though, the market was exploding higher. The team in Beijing engineered the rally by pledging big state support for companies and industries under pressure. A rout driven by fears of defaults, COVID-19 outbreaks and regulatory crackdowns on big tech was replaced in an instant financial euphoria. The Hang Seng China Enterprises Index rallied the most since 2008. Yet this 1998 bookmark is instructive for another reason. That year, too, seemed like a best of times worst of times scenario all its own. That year, the region was several months into the 1997 to 1998 financial crisis. It took a while for turmoil in Thailand, Indonesia and South Korea to open bigger economies. When that finally happened, the fallout was spectacular. Here, think the late 1997 collapse of the then 100-year-old Yamaichi Securities, one of Japan's fabled Big Four brokerages. Or Russia's 1998 default on government debt, an event that killed the long-term capital management hedge fund. Back then, speculators looking for the next Asian domino to fall had two prime targets, China's and Hong Kong's currency pegs to the dollar. Betting was that Beijing might be forced to follow Bangkok, Jakarta and Seoul in devaluing the yuan.